Okay, we have all seen the headlines, right? That massive, sudden spike in the price of oil. But what is really going on behind the scenes? Well, today, we're going to decode the deep geopolitical strategy that's shaking up the energy markets as we speak.
To really get what's happening, we have to start with a huge question. It's a question that really underpins the entire strategy that's playing out in the energy sector right now.
Okay, let's just dive right in. What does it take to control the world? I know, it sounds a little dramatic, right? But the theory we're exploring today suggests that the answer gives us an incredibly powerful way to look at current events, especially in the oil market.
So, the core idea here is this thesis about energy dominance. It basically argues that in our world today, global control isn't just about who has the biggest army, no. It's about who holds the power switch for the entire world economy. This theory of global control really has three parts. First, it starts with mastering artificial intelligence. That's key to optimizing literally everything. The second part is having your own abundant, cheap energy. But here's the real kicker, the third point. To truly dominate, a nation also has to have the ability to make energy expensive for its rivals. Think about it. You're basically putting a brake on their entire economy. So, how is a theory like this actually put into practice? Well, it all comes down to geography and a strategy that's totally focused on controlling the world's most critical bottlenecks. The strategy in concept is pretty simple, but the scale is just massive. The goal is to dominate these narrow sea passages, the choke points, where the world's energy supply is at its most vulnerable. If you can control these, you essentially control the global flow of power itself. Now, looking at this map, you can almost see the whole strategy unfolding. The United States is asserting control or at least influence over most of these critical spots: the Panama Canal, the Red Sea, the Strait of Hormuz, even the new Northwest Passage. This leaves one key vulnerability on the map, and it's a huge one, especially for China, the Strait of Malacca.
All right, let's make this concrete with a real-world example of this theory in action. To really understand the tensions right now and how they're hitting the markets, we need to look at the strategy being used around Iran.
And here's something that is absolutely crucial to understand. The goal here isn't to just destroy infrastructure. That's messy, it's expensive. The objective is much more precise, it's much more surgical. Gain control over the revenue stream.
So, what does that control look like in the real world? This number, it says it all. A staggering 90% of the Iranian regime's oil money flows through one single critical choke point, Karg Island. It is an unbelievable point of leverage. To put it simply, gaining control of that island is the same as gaining control over the regime's income. And reports are suggesting that a naval blockade, not a full-on attack, is what's being considered to do exactly that. You're effectively turning off the tap without destroying the whole sink.
Okay, so we've laid out the geopolitical chessboard. But how did all this tension suddenly translate into that crazy overnight price spike in oil? Was the world all of a sudden running out of crude? Or was something else going on? So, two main theories popped up. The first one is that there was a real, genuine fear of a physical oil shortage. The second is that this was mostly a financial market operation, a speculative event. Let's break down the evidence.
When you really look at the facts, the case for a physical shortage looks pretty weak. Key importers in Asia, like China and Japan, they saw this coming. They spent months building up their reserves, enough to last them about 2 months. On top of that, the US can ramp up production, and the G7 has signaled it's ready to release its own strategic reserves. The bottom line here, the oil is there.
So all of this points us directly to that second theory. It's a dynamic that has its roots not in the oil fields of the Middle East, but on the trading desks of global finance. The real cause looks like a classic short squeeze.
So here's how it all went down. You had a ton of traders who had bet that oil prices were going to fall. But when the geopolitical news broke, the price suddenly jumped up. Well, this triggered all their automated stop-loss orders, forcing those traders to buy back oil futures at a much higher price just to cover their losses. And that sudden wave of forced buying created this massive feedback loop that just launched the price into the stratosphere.
So what does all this mean for an investor? Well, understanding this mix of geopolitics and financial mechanics is really the key to decoding some very, very confusing signals in the market right now.
On the one hand, you see this dramatic, headline-grabbing spike in oil. It's the signal that has everyone talking, shouting about instability and conflict.
But then you look over here, and gold, the traditional safe haven asset, the thing you buy in times of war and uncertainty, is actually falling. Now, that is not normal. This paradox suggests the market doesn't really believe a long, drawn-out conflict is on the way. It senses this was a short-term financial event.
And this leaves us with the final and most crucial question. When the market is sending you such contradictory signals, with oil screaming one thing and gold whispering another, where does the true opportunity for an informed investor actually lie? That's the billion-dollar question.